Welcome back to Chicago, Future of Finance, live from Munich, Germany, at Cboe's RMC conference. That's a Risk Management Conference. We've talked about options. We've talked about crypto. We've talked about data, trillions of dollars being built around the index world. Let's talk some bonds from a bit of a different perspective. Joining me, David Litchfield, who's Director of Derivative Sales at Cboe, based in London. David, great to meet you. Great to see you.
Thank you very much for having me.
We've been talking, I think, just about every asset class today, but we haven't hit bonds. But you think about bonds from an interesting perspective, which is through the way clients use iBoxx futures, which is both high yield and investment grade bond futures. They've been around since 2018. I'll be honest, I'm not as familiar with them as I probably should have been for all the time I think about bonds. But that's because I'm like stuck thinking about what the Fed's going to do. What do you think about?
So it's been an interesting space. Many people in this space only trade OTC. They trade bonds OTC, they trade derivatives OTC, and you introduce something listed to them, and it's completely alien. So we've been through a bit of a process over the last 6 or 7 years of building out the market and getting familiarity. But effectively, they are instruments that a huge swathe of the investing community use and are excited to use.
You came from BlackRock prior. The I in the iBoxx should be a hint that there's a BlackRock partnership in there. So we're using the same underlying indexes for high yield investment grade that BlackRock offers, right?
Similar.
Similar.
So this is where there's a little complication. If you think about, we were to launch another equity index and some futures on that, day one liquidity is almost infinite. You can program trade, have many cash equities, liquidity is easy. You can't trade 1,300 cash bonds,
right? Yeah.
or 2,800 investment grade cash bonds, like you can equities. So we had to be very clever with the product design around liquidity. And the way we've done that is link it explicitly with the two largest ETFs. So the investment grade future is linked explicitly to LQD.
Yep.
And the high yield future is linked explicitly to HYG.
Got it.
Those bonds that those ETFs hold that then form the index that the futures track and settle against.
Okay. Now, do most people use this? Are these institutions that want to hedge out their corporate bond exposure, and they're mostly using these as tools to kind of brush up the portfolio or find, moments if they think the market's going to get volatile? Okay, maybe we'll hedge it with this. Or are people using it like a speculative instrument?
Yeah, everything and all. Like a lot of accounts would use futures. And one of the reasons I get very excited about them is because there are new users being brought into this market that have never been in this market before. So one of the conversations we had with the institutional investors, pensions and insurance, many of them are prohibited from using OTC derivatives. Many of them are not allowed to use ETFs. And so they're sitting on trillions of dollars of corporate credit that they can't effectively hedge. And they can use some govy futures to manage the duration. But you go into them with these futures where they can manage their bond portfolio, and they get very, very excited. And that's trillions of dollars of corporate credit that isn't currently involved in this market. And then all the way down through asset managers, wealth managers, being able to allocate small amounts of futures across multiple portfolios, both on the long side and the short side, and then down into the CTA community is like $350 billion industry that is used to trading futures.
Right.
And now they can trade corporate credit in a futures wrapper.
Interesting. And so they can trade, especially because if you're thinking about bonds, a lot of times you're effectively just trading like a pure duration. If you're going to be, trading treasuries, obviously, is the biggest kind of liquid market for bonds. This gives you a nice way to trade credit speculatively without having to, I guess, do each name of research.
Exactly. You get that index exposure of those cash bonds.
Yeah. What about I'm curious, like the individual, the retailer, or the smaller, person who just wants to kind of speculate on the direction of corporates? Is there a market for that, or would people do they generally gravitate towards equity if they want to express a corporate view?
No, I think the ETF has led many more retail investors into the corporate bonds world than otherwise would have been present before.
Okay.
And the futures are, again, another wrapper that they can use. And we do see some real retail activity.
Yeah.
And it's certainly in the high net worth end of things as well. So the denomination size of these futures is around about 150-ish $1,000 notional, but of course with the margin requirements of futures, you're putting down a fraction of that. So we do see retail adoption.
Okay, so you see, and maybe advisors too on behalf of clients, kind of an in between there, higher net worth retail, they're doing something on behalf of. Is there when you have the Fed generally just being quite dovish and cutting, and it seems like so much driven by that, is there still a great utility in trading the credit side of it, or does duration just drive the bus basically right now?
It does, but the futures offer that wrapper in terms of the corporate credit exposure. It's the duration and the spread.
Right.
And you mentioned a good point around the Fed. Corporate credit markets have traditionally been pushed around by buy side versus sell side. the Fed says something, everyone's a buyer. Fed says something else, everyone's a seller. These futures allow what I would call the more democratization of that market. There are many more users in there using them for many more different use cases. And therefore, the diversification of that liquidity pool is something that's very exciting.
You came from the options side, not so much like a bond trading side. I am curious, though. I mean, I'm sure you're plugged in watching, bond market. We're expecting cuts here coming up. Do you think that materially changes the trend? Because the corporate bond trend generally looks good. I imagine this is not going to hurt.
Yeah, absolutely. And that movement of the market. So a couple of years ago, when the markets were kind of flat and zero interest rates, is all a bit boring. When markets become more volatile, that's when investors have to move their portfolios around. It happens in all asset classes. If the S&P is absolutely flat as a pancake, well, there's not that much need to use options and futures to manage portfolios. When markets become a little bit more volatile, that's when those instruments come into their own.
Got it. Great stuff. Love it. Nice. And we're able to bring it full circle to a little Fed discussion ahead of the news this week. David, great to meet you. Good conversation.
Likewise. Thank you for having me.
All right. The iBoxx futures, IBHY, and IBIG.
For investment grade.
Okay. Great stuff. David Litchfield, Director of Derivative Sales at Cboe. All right. We're nice and warmed up here in Europe. So that means a show tomorrow at the same time. 12:30 p.m. is when we're going to aim to start here tomorrow from Europe. So if you're watching, set your alarm, wake up early in Chicago or New York, or maybe just tune in. You can always watch the replay on X, on YouTube, LinkedIn as well. I'm Oliver Renick. Thanks for tuning in. Also, tomorrow, going to do a great panel here at RMC for those who are watching, talking about hedging cross-asset risk. That's in the morning at 9:30 here for those that are in town. If you're not here yet, come on through. Conference is great. I'll see you tomorrow. Thanks for tuning in.